I'm excited to be with you today for another incredible live session. Whether you've been with us for a while, because we've got a jam-packed session full of insight, strategies, and kind of tips that will take your trading game to a whole new level. So let's get some love in the chat, drop your favorite emoji, hit that like button, and let me see where you're tuning in from, whether it's New York, Tokyo, or anywhere in between. We want to hear from you. So the WeMasterTrade community is global, and today we're all in it together. So if you're not subscribed yet, you know what to do. Smack the subscribe button and stay in the loop for all the tips and tricks that will help you level up. Alright, I'm loving the energy already. We've got traders tuning in from all over the world, and it's awesome to see that everyone coming together to share, learn and grow. So let's keep that momentum going, because today's session is going to be next level. We've got some special guests here who are here to share their stories and strategies that will help them rise to the top of their game. So trust me, you don't want to miss a single word. So first up, I have the honours of introducing Helen, an absolute beast in the Forex market. Helen has been mastering Forex trading for over 2 years and a half, and she's here to share some seriously valuable insight with all of you. So Helen, how's it going?
Hey agents, I'm feeling fantastic and thrilled to be here. It's always wonderful to engage with the WeMasterTrade community and discuss the successful about this. I'm eager to delve into some strategies I've been applying in the foreign markets.
I love your energy, Helen, and I know that our audience is bound to hear all about your Forex journey. Well, before we get into that, let's not forget about our next guest scholar. Scholar's been dominating the fund trading scenes, especially in the high-stake world of crypto and stock. So, Scholar, how's it going?
Hi Aidan, I'm equally excited to be here. This session is always our first topics for discussion, and today I'm thrilled to share some of the strategies that have been effective for me in fund trading, and it's going to be an engaging session.
So that's what we love to hear. So for everyone watching, make sure you've got your notepad ready, because Helen and Scholar are about to drop some serious knowledge bombs, and we'll be diving deep into the experiences, challenges and these strategies that will help them thrive in the fast-paced world of trading. Alright Helen, let's kick things up with you. You've been trading Forex for over 1.5 years now, and I know that the Forex market can be a bit of a roller coaster. So can you tell us how you got your start in Forex trading and what led you to choose WeMasterTrade as your platform?
Certainly, agents, I began Forex trading about 2 years ago. What captivated me initially was the market vibrancy and perpetual activity. The foreign market is sensationally dynamic, and I was attracted to the concepts that there is always potential for success regardless of the circumstance. When I further discovered WeMasterTrade, I immediately resonated with me at a perfect match. The resources they provide, including sophisticated technical analysis and access to a real-time truly impressed me. However, it was a community aspect that clinched it for me. WeMasterTrade places a strong emphasis on aiding trader success by offering essential tools and support to advance regardless of your starting point.
So that's fantastic, Helen. It sounds like WeMasterTrade has really helped you evaluate your game. Now, Forex is known for its volatility, and sometimes it can make or break a trader. So how do you handle the ups and downs of the market without letting the patches get to you?
A great question. Volatility can be challenging, but it also where the real opportunity is. The key is having a solid risk management plan. I always say you have to respect the risk. It's important to stay disciplined, and WeMasterTrade risk management tool help me do that. Their real-time alert and customizable risk parameter allow me to react quickly but with control. When the market moves fast, you have to stay calm, track your strategy, and not let emotion take over. And for me, that's where WeMasterTrade feature really shine.
So pick some seriously valuable insights, Helen. Managing risks and staying cool under pressures is definitely key in forward trading. Now, Scarlett, let's switch gears to fund trading. You've been crushing it for nearly 2 years, specializing in low-term strategies. So can you tell us what drew you to fund trading and how it differs from other forms of trading?
Absolutely. Then fund trading revolves around strategic, long-term growth. It's not about seeking quick wins, but constructing a portfolio that can steadily advance over time. What truly distinguishes fund trading is the need to consider both short-term and long-term perspectives. Careful risk management is crucial while simultaneously keeping an eye out for emerging opportunities. WeMasterTrade real data and analysis tools has been instrumental in achieving this balance. They enable me to make well-informed decisions that align with my long-term strategy, even when the market presents unexpected challenges.
So I love that. Fund trading definitely seems that it requires a lot of patience and foresight. So Scarlett, how do you stay focused on the bigger picture, especially when the market gets rocky?
Well, patience is paramount in fund trading. The market experiences fluctuations, but short-term ups and downs shouldn't dictate your long-term strategy. A crucial lesson I've learned is to maintain emotional detachment. Don't get overly excited when things are going well, and don't panic when the market dips. WeMasterTrade risk management tools assist me to stay in discipline even during volatility. I can set precise risk parameters and have a peace of mind knowing that I'm not overexposed, even when the market behaves unpredictably.
To pick such solid advice, keeping emotions in check is definitely a big part of being successful in trading. So you both have shared some serious gems so far, but let's talk about the tools that will help you get to where you are today. So Alan, could you share one specific features in WeMasterTrade that's been a game changer for you in Forex?
Definitely. A tool I absolutely rely on. Either account aside features is offered up to the minute data on how my account is performing, and I use to observe pattern, evaluate my trades, and make a better informed choice. Whether I'm pinpointing the bad time to enter the markets or deciphering market trend, this tool gives me an edge. It has enabled to spot opportunities that might not have been noticed otherwise.
So it sounds like a tool to game changers. I think the real-time insights is crucial, especially when you need to make quick decisions. So Scarlett, how about you? What's been your go-to tool in fund trading?
Well, for me, it's all about the risk management tools. They allow me to customize the amount of risk I'm willing to take on any trade. This has been key for me, especially in volatile markets like crypto. WeMasterTrade helps me stay disciplined and in control, ensuring that I never take on more risk than I'm comfortable with. That's what keeps me grounded even when the market is going wide.
So risk management is really important, especially in today's fast-moving market. Whether you're in Forex or fund trading, having the right tools makes a world of difference. So I hope that everybody's taking notes because Helen and Scarlett are dropping some serious pro-level insight today. So, alright traders, we're kicking up the notch because it's time to dive into one of the most powerful features here at WeMasterTrade, the packets comparison. So whether you're a new phase newbie or eager to get your feet wet, or a seasoned pro looking to scale up your game to new highs, this segment is for you because this is where you'll find the perfect trading package to match your goals and take your trading from good to great. So let's be clear, WeMasterTrade, we know that there's no one-size-fits-all in trading. Every trader is unique with different styles, risk tolerance and strategies. So that's why we offer multiple customizable packages to meet you exactly where you are today. So whether you're aiming for high risk and high rewards or you prefer the steady methodical approach, there's something here for you. And to break it all down, I've got the awesome Helen and Scarlett, two of WeMasterTrade Finance. They both work closely with these packages and they're here to give us the inside scoop on how to leverage each one to the full potential. So let's jump in. Helen, you've been with WeMasterTrade for a while now, and you've seen firsthand how these packages can evaluate a trader experience. So can you kick things up by walking us through how both new and experienced trader can benefit from the package comparisons, and why is it a game-changing feature in the WeMasterTrade experience?
Absolutely, agents. I really enjoy discussing these packages because it's where the trader can truly customize their experience. The packet comparison feature simplifies the process for traders to understand precisely what they are getting. When you visit the website, there are detailed comparative overview of each packet that include information like the initial balance, profit targets, data loss limit, and more. All the essential details are presented in the straightforward, easy to navigate table. Is for the structure to assist trader in selecting the pattern for their success. Let's talk about the standard packets, one of the most popular options. Their one is great for traders who got some experience and are ready to level up. You start with an initial balance of up to 200,000, which gives you plenty of room to trade confidently and make a strategic move. The profit target set at 6%, which is perfect for traders aiming for steady, sustainable growth. And the latest loss cap is 4%, so we got enough breathing room to ride out market swing without stress too much. It's an awesome balance between opportunity and security.
So that sounds like a perfect stepping stone for traders looking to level up without jumping in too deep or too quickly. A 200,000K balance and a solid 6% profit target give you a ton of flexibility to build momentum. But for those who are looking for something a bit more feelings, let's talk about the 5-10-10 package, Helen. I hear that this one's a favorite for high risk, high reward traders, and what makes the 5-10-10 such a standout?
The 5-10-10 package. Now we can talking big play. Like the standard packet, you start with the 200,000, but this packet is for those traders who are ready to take a bigger on risk for bigger rewards. The data loss cap is 5%, giving you more flexibility in how you handle the markets. But here the kicker, the profit target jumps to the 10%. This is perfect for the traders who have confidence in their strategies and are looking to make their major gain. It's about having a higher tolerance for risk in a trend for the bigger payouts.
So that's what I'm talking about, a 5% loss cap and a 10% profit target. That's typical for traders who aren't afraid to go big and swing for the fences. But what if someone's looking for something more relaxed? Maybe they want something simpler without all the pressures of hitting specific profit target. So Scholar, I've heard about the 5-10-0 package, so can you break it down for us?
Well, absolutely. The 5-10-0 package is ideal for traders who want a straightforward, no-nonsense approach. You start with a $100,000 and $1,000 balance, but here's the cool part. There's no profit target. You can trade freely without the stress of hitting specific percentages. It's just you, the market, and your strategies. The daily loss cap stay at 5%. Giving you some structure, but the beauty here is that it allows traders to focus on consistency without worrying about specific goals.
So that sounds like a dream for traders who just want to trade without all the restrictions. Talk to freedom, no pressures, just you and the market. Now, Scholar, about those traders who want a bit more control over the risk management but still want to play in the high-stake arena. So what can you tell us about the 5-10-10 no PC package?
Well, about a 5-10-10 no PC package is perfect for traders who want more control over their trades. You should still get the $200,000 and $1,000 starting balance and the 5% daily loss cap, but the flexibility is the real selling point here. This package allows you to tweak and adjust your trading parameters to match your style and risk management preferences. Whether you're reacting to market changes or want to experiment with different strategies, this package gives you the freedom to adapt without losing the safety net of risk management.
So flexibility and control in a volatile market, it's huge, and I love how these packages are giving traders more way to adapt and grow. So now we'll cover all, but I've been hearing whispers for something really special, the custom package. So Helen, tell us, what makes this one so exciting?
Well, the custom package is where the thing get really exciting. This is for the traders who want it all: full control, full customization, and the massive starting balance. You got a jaw-dropping $1 million initial balance. Yes, 1 million. But that's just the beginning. The real beauty that you can customize everything: the daily loss limit, overall loss limit, or even your profit targets. It's perfect for traders who know exactly what they're doing and want to grab a trading experience that matches their exact need. It's the ultimate freedom and control.
So $1 million starting balance and the ability to customize your entire trading experience, I believe that's next level trading. Whether you're a risk taker or a methodical trader, the custom package sounds like the ultimate playground for those who want to take the trading to the stratosphere. Alright, traders, let's quickly recap whether you've been just starting with the standard package or going for bigger reward with the 5-10-10 package, enjoying full freedom with 5-10-0, or taking control with the 5-10-10 no PC, or customize everything with the custom package. WeMasterTrade has the perfect option for you. So the only question is, which one is calling your name? So head over to the package section on our website right now and check it out for yourself. We've got packages designed to fit every trader no matter where you are in your journey. Let us know in the chat which package speaks to you, and our team is ready to get you guys started. The features of trading is in your hands, so let's make it happen. Alright, this is where magic is going to happen. We'll talk about packages and how you can jumpstart your trading journey with WeMasterTrade. But let's be real, success in trading isn't just about the package that you choose, it's also about understanding and sticking to the rules. So the conditions that we'll set here at WeMasterTrade are designed to not only keep you safe, but also help you grow and take your strategy to the next level. Now, whether you're just getting started or you've been trading for years, these conditions will act as your roadmap. So let's dive into the rules to define our trading environments, because if you understand the rules, you can master the game. So first on the list, and arguably one of the most important, the daily loss limit. So Scarlett, you've been through it all, the high, the low. So can you kick things up by explaining to everyone how this daily loss limit works, and why is it so crucial for managing risk?
Absolutely, Aidan. The daily loss limit is one of the most essential protections any trader can employ. It serves as a daily breaker to prevent you from suffering significant losses on a challenging day. The concept is straightforward. There is a limit to how much you can lose in a single day of trading, and is determined by the greater whole of two values: your account balance or your equity at the beginning of the day. So let me break that down with an example so everyone understands it clearly. So with the example, first example, let's say you got a balance of $105,000, but due to some overtrades, your equity, including flowing profit and loss, is $107,000 at the start of the day. If you're working with a 4% daily loss limit, that means you can lose up to $4,000. If your equities falls below $103,000, you're done trading for a day. And with the second example, on the flip side, if your balance is $100,000 and your equity is $99,000, the same 4% loss limit would mean your account would be liquidated if your equity dips below $96,000. The point is the daily loss limit is there to make sure that a bad day doesn't wipe you out completely, and is about protecting your account and giving you the chance to regroup and come back stronger the next day.
So got it. So it's like an insurance policy for your trading day. You hit that limit and boom, you're up before things get out of hand. But what happens if a trader accidentally crosses that line? Can they keep trading?
A great question, Aidan. No, if you break the daily loss limit, your account is automatically liquidated. or your open position will be closed and you won't able to trade again until the next day or unless you buy a new trading package. Here's the thing, this liquidation is automatic and immediate. It is designed that way to prevent further losses. But here's the word of caution, market fluctuation. Fluctuation can sometimes cause you to lose a bit more than the limit, depending on how fast the market is moving.
So it's a hard sell, definitely something traders should keep an eye on to avoid. And now they will understand what the daily loss limit is and what happens when it hits. So the next question is how to avoid hitting that limit in the first place. So Scarlett, you've been in the trading trenches for years. Can you share some practical strategies that trader can use to stay within the daily loss limit? Where it all is?
You got it, agent. Stay within the daily loss limit is all about discipline and following a solid risk management plan. Here are the key strategies that have worked wonderful for me and countless other traders. First, and I can't stress this enough, always use a stop loss. I know it sounds simple, but it's absolutely critical. The stop loss ensures that if the market moves against you, you're out of the trade before things get out of hand. Think of it as your safety net.
So it's like setting up guardrails on a mountain road, right? It's that to stop you before you go off the cliff.
Exactly, Aiden, and it's that extra layer of protection. Now the second strategy is position sizing. This is where a lot of traders slip up. You should never risk too much on a single day trade. A good rule of thumb is to risk no more than 1 to 2% of your account balance per trade. This way, even if the trade doesn't go your way, you're still far from hitting your daily loss limit, and you can keep trading without any major setbacks.
So it's like building your defense, and you don't put everything in the one place, right? You spread out the routes. That actually makes sense. But what about those moments when traders feel tempted to chase after the losses? Trying to get it all back in one trade.
Oh, that's a big one. Chasing losses is one of the biggest mistakes traders make, especially newer ones. This brings me to my third strategy, don't chase losses. If you're having a tough day, take a step back. The market will always be there tomorrow. If you start chasing losses, trying to recover too quickly, it's easy to make emotional decisions that can lead to even bigger losses. And before you know it, you hit that daily loss limit and you're out for the day.
So true, it's like trying to sprint when you're ready one day, you will later to make a mistake. Now Scarlett, these strategies sound spot on, but how do traders stay mentally strong when things aren't going their way? What keeps them from falling into the emotional traps of chasing losses?
Well, it's all about mindset. And trading is just as much a mental game as it is a number game. You got to stay calm and focused. One trick is to always have a trading plan before you even place a trade. That way, when things get tough, you stick to the plan and avoid making impulsive moves. And if you find yourself getting emotional, just stop. Take a break, step away from the screen, and reset your mindset.
Thank you, Scarlett, for those incredible tips on managing daily loss. So next up, we're going to enter a short break, and after that, we're going to continue with the current promotions plan that we're currently offering and today's economic calendar.
copy trade. Copy trade. Copy trade. We copy trade. We copy trade. Copy trade.
Well, welcome back everybody. So next up we're going to under a really interesting case topic here, the profit consistency rule. So this rule is crucial for ensuring long-term sustainable success in trading as it helps managers and maintain consistency in your profit. So now to give us a clear picture of how profit consistency rule works and why this is so important, let's turn to Helen. So Helen, can you break down rule for us, how it is calculated, and why is it such important for traders to focus on the consistency rather than just aiming for big wins?
Of course, Aiden, the profit consistency rules is a powerful matrix that help you understand how stable your profits are over time. It's not just about making big gains on one or two good days. It's about being a consistent day in and day out. So, here how profit consistency rule is calculated. You take your highest single day profit and divide it by the total of all your profits and losses over a given period, usually a month or a quarter. You then express that result as a percentage. Let's go to an example. Let's say the bad day brought in $200 in profit, but over the month your total profit and losses add up to 410. In that case, your profit consistency ratio could be about 48.7%. So this ratio shows how much your performance comes from one standout day. Ideally, you want this percentage to be lower, under 20%, because that means your profits are more evenly spread out across on your trading days. Now, why it is important? A low profit consistency ratio indicates that you're not just relying on a couple of big wins to stay profitable. Instead, you're showing that your strategy works consistently over time, even on the dull days when the market isn't giving you the big win. The kind of consistency is the hallmark of a successful long-term trader.
It's a great explanation, Helen. So just to clarify, a lower ratio means that you're more likely to make steady gains rather than being overly dependent on a few good days, right?
Exactly, agents. When you rely on just a few big wins, it often means that your strategy is risky or inconsistent. You could go through long stretches where you're not making much money or even losing it. But if your profit consistency ratio is low, it shows that your performance is smoother and that your trading is more predictable and stable over time.
So that's incredibly insightful, and it seems like it's a critical metric for any trader who's serious about long-term success, right?
Exactly. Consistency is the key to sustainable profitability. Big wins are great, but if they flow by the big losses or long periods of break-even trading, it's hard to maintain momentum. With the profit consistency rule, traders can keep an eye on how reliable their strategy is over time.
So now that we've got a solid understanding of what the profit consistency rule is, so let's dig into some practical strategies to help traders maintain a low ratio, easily under 20%. So Scarlett, you've got some great tips for us. So can you walk us through some of these techniques that traders can use to stay consistent and ensure that ratio stays in check?
Absolutely, Aiden. The profit consistency ratio is a powerful indicator, but it takes careful management to keep it low. So let's talk about some practical ways traders can improve their consistency and avoid becoming too dependent on those rare big wins. First, one of the most effective strategies to keep your profit consistency ratio low is to diversify your trades. This means spreading your investments across different markets, asset classes, or even trading strategies. If you only trade one market, say Forex or stock, you risk being too reliant on that market's performance. By diversifying, you reduce the impact of any single loss and create more stability in your overall performance.
So that makes a lot of sense. So if you're only trading in, let's say, the US stock market, about we could really hit my point because in hard, but buying trades and example commodities or forex, I could balance some of that risk, right?
Exactly. That is all about balance. When one market isn't performing well, another market might be doing better. This way, your overall performance stays smoother and you're not relying on just one or two trades to pull you through. Next up is position sizing. One of the biggest mistakes traders make is over leveraging, taking on positions that are too large large relative to their account balance. For example, if you have a $10,000 account, putting $5,000 into a single trade is risky because if that trade goes south, you could lose a significant portion of your capital. Instead, aim to keep your position size small and manageable, say no more than 1 to 2% of your account balance per trade. This reduces your risk and helps ensure that losses don't overwhelm your profits.
Right, so it's just not about picking the right trades, but also making sure that you're not putting too much of your capital at risk on any single trade. Smaller, more controlled trades lead to steadier results over time, right?
Exactly. By managing position sizing, you prevent any single trade from having too much impact on your overall performance. It's all about control and discipline. Another crucial element is having a well-defined trading plan. Without a plan, it's easy to caught up in the emotions of trading, whether there's the excitement of a potential win or a panic of a sudden loss. A solid plan outlines exactly when you enter a trade, when you exit, and how much risk you're willing to take. Having these rules in place keeps you grounded and helps ensure that your trading decisions are consistent, which in turn helps keep your profit consistency ratio in check.
That's a really good point. A lot of traders, especially new ones, probably jump into trades without a solid plan and end up making an emotional decision, right?
Absolutely, Aiden. It's easy to get emotional in the heat of the moment, but if you have a plan, it's much easier to stay disciplined and avoid impulsive trades that could hurt your performance. This brings us to stop loss order. A stop loss is an automatic exit that you set up to close a trade if it moves against you. This helps to cap your losses on any single trade and protect your account balance. By using stop loss orders, you can avoid those catastrophic losses that can throw off your profit consistency.
So I like the ideas of using stop loss order. It's as like a way to take the emotions out of the decision-making process.
Exactly, it's like setting a safety net. Once your stop loss is in place, you don't have to worry about watching the trade 24/7. If things go south, the stop loss takes you out of the trade automatically, helping you stick to your plan and avoid large unexpected losses. Another important strategy is to regularly review your performance. Just because you set up a solid plan and strategies doesn't mean you should put everything on autopilot. It's crucial to track your trades, see what's working, and make adjustments as needed. You might find that certain markets or strategies are delivering more consistent results than others. By keeping a close eye on your performance, you can tweak your approach and improve your consistency over time.
So take performing maintenance on your trading strategies, always looking for ways to optimize and improve.
Exactly, just like car need regular tunes up, your trading plans does too. Continuous improvement is key to keeping your profits steady. Finally, this is a big one: avoid emotional trading. Whether it's fear after a loss or overconfidence after a win, emotions can lead to poor decision making. If you stick to your strategy and avoid chasing losses or getting overly excited after a good day, you'll see much more consistent results.
So that's such an important point, staying calm and disciplined even when the market is going crazy. It is easier said than done, though, right?
It definitely takes practice, but staying level-headed is crucial for long-term success. If you can control your emotion and stick to your plan, you'll be far more likely to maintain consistency profits.
So next up, we're going to dive into another crucial aspect of effective trading, the risk uncertainty rule. So this rule is key to maintaining both stability and latent probability in your account. So, Scarlett, I know that you've got a great way of explaining it. So can you walk us through what the risk consistency rule is and why it's so important for traders to follow?
Sure thing, Aiden. The risk consistency rule is all about ensuring that you manage your risk in a disciplined, consistent manner. It limits the risk per trade to no more than 2% of your initial account balance. This is really important because it prevents loss swing in your equity and helps mitigate the risk of significant losses due to sudden market movements or unexpected events. So let's break it down a little more. First, the maximum risk per trade idea. That means you shouldn't risk no more than 2% of your initial balance on any single trade idea. This includes any floating losses, so you need to factor in all potential exposure. Next is trade idea definition. Multiple trades on the same assets in the same direction are considered as a single trade idea. On the other hand, trades on different assets or in opposite directions are treated as separate ideas. For example, if you open several positions on gold buy, they could count as one trade idea, and the combined risk must remain under 2%. But if you have a gold buy and a GPY sell, they're treated as two separate ideas, each with their own 2% risk limit. Following these rules smooths out your equity curves, encourage disciplined trading, and most importantly, reduce the chances of massive losses.
So thanks, Scarlett. That's a really helpful overview. Now let's move through this back to our audience for a second. So traders, have any of you ever found it tricky to stick to the risk consistency rule? How does it feel to have those limits in the place, and does it even get in the way of your trading strategy?
Absolutely, Aiden. The main point to remember about the risk consistency rules are risk per trade idea. Stick to risking no more than 2% of your initial balance on any single trade idea. This keeps potential losses manageable and ensure you don't risk too much on any one trade. The second one, single trade idea. If you open multiple trades on the same asset and in the same direction, they count as one trade idea. So your combined risk must stay within that 2%. And finally, the second trade idea. Trade on the different assets or in different directions are considered separate ideas. Each idea can have a S at 2% risk, but be mindful to keep track of them. And why does this matter? It stabilizes your equity curves by preventing huge swing in your account balance. It promotes discipline by encouraging traders to think more carefully about their risk, and more important, it reduces the risk of the major losses that can really hurt your overall performance. So in short, adhering to the rule help keep your trading account stable and support long-term success.
So, great, Helen. I know that some of you might be wondering how to make sure you actually stick to the rule. So let's just get into some practical strategies for making it easier to follow. So, Scarlett, could you share some few tips on how traders can stay disciplined and avoid breaking the risk consistency rule?
Of course, I don't stick to the risk consistency rules. Take some planning and discipline, but it's totally doable with the right strategy in place. Here are a few key tips. First and foremost, clearly set your maximum risk per trade ID to stay within 2% limit. You can use risk management tools or calculators to help with this. Most platforms have built-in tools that allow you to automate risk limits.
So that's a good point. Having the automation takes a lot of the pressures off, right? No need to constantly double check your platform does a heavy lifting.
Well, exactly. It makes so much easier to stick to your risk limits when the platform is handling the numbers for you. It's also important to keep track of the total risk across multiple trades on the same asset. For instance, if you open several positions on gold buy, make sure the combined risk of all those trades doesn't exceed 2%. This is where traders sometimes slip up. they open multiple positions without realizing that combined, they're risky more than they intended.
So even though the trades are technically separated, they're on the same asset, so we want to look at them as one identity, right?
Exactly, I don't treat them as one idea because they're all exposed to the same market movements. Speaking of different trades, it's equally important to treat trades on different assets or in opposite direction as separate ideas. This way you can manage each trade risk individually without exceeding the 2% rules on any single trade.
So right, so you could be, running a gold buy and a GBP, JBY sales at the same time without battling the rules, allowing you manage your risk for each one separately.
Exactly, just make sure you're keeping an eye out on the risk on each idea individually. I also recommend using risk management filters as many trading platforms offer, like automatic position sizing or stop loss orders. These tools can help control your exposure and prevent you from overextending your risk.
So I imagine these tools really help prevent those moments where you're tempted to take on too much risk in the heat of the moment, right?
Absolutely, it takes the emotion out of the equation and helps you stay disciplined. Lastly, make it a habit to regularly review your trading activity. This is sometimes a lot of traders neglect. Reviewing your trades helps ensure that your risk per trade idea remains within the set limits. And if you notice any patterns or areas where you are taking on too much risk, you can adjust your strategy to stay compliant.
So it sounds like regular check-ins are crucial to spotting potential issues before they become big problems.
Exactly, and it's all about staying proactive.
So great tip, Scarlett. So next up, we're going to enter the economic calendar of today, okay? So can Helen and Scarlett help me with this?
Yeah, okay.
Well, sure. So we will go to our calendar news for today. So today's economic calendar highlights several high-impact events that could influence financial markets, investor sentiment, and economic policy. The events are categorized based on their expected market impact, covering key economies like the US, USD, Australia, AUD, New Zealand, NZD, and China, CNY. Below is an in-depth analysis of each event. So first, we have a USD FOMC meeting minutes, high impact. The scheduled times is 2 a.m. where the Federal Open Market Committee FOMC meeting minutes provide insights into the Federal Reserve's stance on interest rates, economic outlook, and inflation. Markets closely analyze the minutes for potential hints about future monetary policy and potential impacts on financial markets if the minutes suggest a hawkish stance. Concern over inflation, potential rate hikes, USD strengthens, stock weakened due to a concern over tightening liquidity. A dovish stance focused on economic growth, potential rate cuts, weakens the USD but pushes equities and commodities. Another investor, bond investor, will watch for interest rate cues. Higher rates may lead to a sell-off in bonds, increasing yields. For forex traders, USD pairs like EUR-USD, USD-GYP, and GBP-USD will be highly volatile as traders react to policy expectations. And for economists, provides crucial insights into how the Fed views economic risk, which could shape forecasts for GDP growth and inflation trends. The second news is NZD, or RBNZ Governor, or speaks at scheduled time is 2 and 10 a.m. New Zealand Reserve Bank, which is RBNZ Governor, Andrew R. delivered a speech that could provide insight into the central bank's monetary policy stance, inflation expectation and economic outlook, potential impact on the financial market if all signals are rate cut or policy easing, NZD weakens as lower rates reduce attractiveness. A hawkish tone could strengthen the NZD but may pressure New Zealand stock market. For forex trader, NZD USD, AUD NZD and NZD-TPY pairs may experience increased volatility. And for investor, equity and bond investor will monitor the speech for changes in policy that impact borrowing cost and economic growth. With the next news, USD President Trump speak, scheduled time at 5 a.m. Speeches by the U.S. President can significantly impact financial market, particularly if they touch on trade policies, fiscal spending, or economic growth expectation, and potential impact on financial market if Trump discusses tariff, trade wars, or tax policies. Stock and USD pairs could react sharply. Positive sentiment on the economy could lift equities, while uncertainty could drive risk-off sentiment. Our forex trader, high volatility expected in USD-related pairs, depending on market interpretation of his statements, and on investors, stock market sectors like defense, tech, and manufacturing could react to policy discussion. The next is AUD employment change, scheduled time at 7:30 a.m. This report measured the change in the number of employed people in Australia. A higher than expected reading is positive for the AUD as it indicates economic strength, while a weak reading signals slowing growth and potential impact on financial market is better than expected job growth, which is 44K with a 90.4K forecast. Puts confidence in the Australian economy, strengthening the AUD. Australian stock markets may benefit from a strong labor market, particularly consumer and financial sector. Our forex trader, AUD and USD and AUD-TPY will be impacted based on how traders interpret the employment strength in relation to RPA rate expectation. And on investor, more jobs may lead to higher consumer spending, boosting retail and housing stock. And next up, Helen could help me with the rest.
Okay, the next news for the AUD's unemployment rate, the highest, the scheduled time at 5:30 a.m. The unemployment rate reflects the percentage of unemployed individuals' activity signatures. A higher than expected rate can weaken the AUD, while a lower rate strengthens it. The potential impact for the financial market. A slight increase from the 4% to 4.1% may dampen optimism, but unlikely to cause the major market shift. If the job growth remains strong, the market may overlook the small rise in unemployment. For the investor and forex traders, AUD volatility will increase, but the effect may be given the strong employment trends figure. The next news to CNY loan program rate decision. Scheduled time at 8 a.m. China's central bank set a loan program rate which affect borrowing costs for the business and the customer of potential impact for the financial markets. Unchanges rates suggest the PBOC remain cautious about the inflation and economic slowdown. Stability in the Chinese rate support global rate sentiment and commodities like oil and metal. For the forex traders, CNY stability influence UD, and emerging markets currency, since Australia heavily trade with China. And the last news is the USD unemployment claim, scheduled time at the 8:30 p.m. Weekly unemployment claim measure the number of the new jobless claims filed by the individuals seeking unemployment benefits. Potential impact for the financial markets. A slight increase indicates stable labor market conditions. It can rise and significantly in the future week. Market may begin rising in economic slowdown rate. For the forex trader, minimal impact on USD unless the major deviation occurs. For the economists, quickly climb the serve an early indicator of employment trend, sharpening GDP forecast, each or the news for today.
So thank you all for joining us today, and we hope this session has been informative as you are as excited about the opportunities here at WeMasterTrade as we are. So remember to like, subscribe and share the live stream with others who might benefit from it, and don't forget to follow us on our social media platforms for more updates, promotion and trading tips. Stay tuned for our upcoming events, and we look forward to seeing you again soon. So until next time, happy trading.